All right, let's now dive into a special tax rule referred to as the Kiddie Tax. Come on, leave the children out of this. No, the Kiddie Tax isn't fully what it sounds like. The Kiddie Tax is actually meant to go after wealthy people that try and pass their income to kids and report it at the child's lower tax rate. So this rule is the IRS preventing parents from shifting investment income into a child's lower tax bracket to minimize tax. Okay, so the IRS saw this strategy being abused decades ago. So the Kiddie Tax rules were implemented to neutralize that advantage. Here's what it really means. If a child has unearned income, meaning things like interest, dividends, capital gains, passive income, and that child is still considered dependent, the IRS can tax that unearned income at the parent's marginal tax rate instead of the child's. So we have a very simple 4-step mental map that you are going to need to remember, and this calculation will be easy money on the exam. So taking a look at our Kiddie Tax mental map. Step 1, we want to first ask ourselves, does the child qualify? So we're first determining if Kiddie Tax even applies. So the rule here is that the child must be dependent and either under age 18 or a full-time student age 18 to 23 who does not provide more than half of their own support. If they meet this, then Kiddie Tax rules will apply. All right, so we first met that test. Now we're diving into the calculation. So step 1 in this calculation that you need to know is that the first threshold amount of unearned income, which is this number, is not taxed. Once Kiddie Tax applies, this first amount of unearned income is completely excluded and not taxed at all. This basically acts like a small buffer before anything gets taxed. All right, so this is also known as the child's standard deduction, meaning up to this point, we are reducing or deducting this amount, which basically nullifies the taxable amount and brings it to zero. Okay, so the next portion of this threshold amount is taxed at the child's tax rate. All right, so after the first exclusion, the next amount of unearned income is taxed using the child's marginal tax rate, usually 10% because they're kids with almost no earned income. So basically it's the first half and the second half. Anything in excess over this total amount is taxed at the parent's marginal tax rate. So this is the actual Kiddie Tax portion, and this is the part Congress didn't want parents shifting into lower tax brackets for dependents. Okay, so if we're to simplify this, Kiddie Tax takes the first amount tax-free, the next amount is taxed at the child's tax rate, and anything above that gets taxed at the parent's rate. So we're going to now meet this family right here. We have Dave, who's the dad, Margie, the mom, and their daughter, Minnie, who's under age 18. They also have their son, Stu, who is a full-time college student and 19 years old. So we're going to be using this family for all Kiddie Tax examples inside TCP, so it sticks visually, conceptually, and numerically for you. So when do the Kiddie Tax rules apply? The Kiddie Tax rule says that certain unearned income of a child, things like interest, dividends, investment gains, is not taxed at the child's tax bracket. Instead, it will be taxed at the parent's marginal tax rate. So before you even begin any Kiddie Tax calculation, step 1 in your brain is, does this child qualify to even be subject to Kiddie Tax? And again, a child is subject to Kiddie Tax if they are a dependent child under age 18 or a dependent full-time student age 18 to 23 who does not provide more than 50% of their own support. All right, so inside our Universal CPA family, Minnie, who is under 18, would qualify, and Stu would also qualify because he is a full-time college student who is 19, right, between 18 and 23. So he would also qualify as long as he is still a dependent and is not supporting himself more than 50%. All right, so the entire point of Kiddie Tax is to prevent parents from shifting that income to the lower taxed child, meaning Congress does not want Dave and Margie to move investments into Minnie or Stu's name just to get taxed at a lower rate. So this is literally Congress saying, nice try, but that investment income still gets taxed at your parents' marginal tax bracket. All right, so we're talking to you, Dave and Margie. So anytime you see under 18 or dependent full-time student 18 to 23 and they have unearned income, your kiddie tax radar should turn on immediately. So now that we know when kiddie tax applies, let's lock this visually into your long-term memory using our Universal CPA kiddie tax family. All right, so on the left, you'll see this little chart. This is your fast recall cheat code for the exam. All right, so dad is Dave. So that is going to be D equals dad's tax rate. Mom is Margie, and that's M. All right, so mom's tax rate is going to stand for the M. And the kiddie tax calculation always ties back to the parent's marginal tax rate. All right, so right from the top, Dave and Margie's tax bracket is what matters most. Then we have the children. All right, so Minnie, she's our M for minor, meaning she's under age 18. Minnie is the classic scenario where kiddie tax almost always applies because minors very rarely provide more than 50% of their own support. And Stu is the full-time college student, age 18 to 23. And the S in Stu equals student. All right, but with Stu, you also have to remember the extra support test. All right, so he qualifies for kiddie tax only if he does not provide more than half of his own support. That's the nuance a ton of candidates forget. Okay, so mentally this is your trigger. If the child is Minnie age, you automatically think kiddie tax applies. If the child is Stu age, kiddie tax probably applies, but check support. So this little naming system is intentionally engineered to remove hesitation on exam day. Because when you see unearned income on the exam, you do not stop and wonder, does this kid qualify or not? Your brain should instantly categorize them Dave, Margie, Minnie, or Stu. And from that, you immediately know what tax rate you end up using once you get to step 4. All right, so now that we know when kiddie tax applies, now we need to talk about what income we actually apply this to and how we calculate the amounts that get taxed. All right, so this is all about calculating net unearned income. And I want you to think about this as investment income Minnie or Stu earns that wasn't from them actually working. All right, so net unearned income includes, again, interest, dividends, capital gains, rental income, could be royalty income, all of that passive type of income. And the formula is simple. Net unearned income equals total unearned income minus the allowable exclusions. All right, and those allowable exclusions are structured in 3 tiers. And this is where students get tripped up. So follow the roadmap. All right, so we're talking about step 2, 3, and 4 in our mental map. The first amount is sheltered, and this is essentially the dependent standard deduction for unearned income. The next amount is taxed at the child's tax rate, and anything above that total threshold gets taxed at the parent's marginal tax rate under kiddie tax rules. Now remember, in this module, most of what we're focused on is unearned investment income. This is the core of kiddie tax, but I do want to plant a quick seed so that you don't confuse this later. If Minnie is earning actual wages, like let's say that she gets a part-time job as a waitress at the pizza shop, that is earned income, not unearned income. And when a child has earned income, their standard deduction is earned income plus $450 minus up to the single standard deduction limit of $15,000. All right, so earned income follows normal dependent standard deduction rules. Kiddie tax is not about earned wages. Kiddie tax is about the kid earning investment income they didn't work for. And that is what the IRS is concerned about shifting down to lower tax brackets. All right, and one last reminder, parents also have an option. If the child only has interest, dividends, and capital gain distributions, and that unearned income is between these amounts, the parents can elect to report the child's unearned income directly on the parent's tax return instead. All right, so this is about understanding the 3 layers of deductions, knowing what counts as unearned income, and mentally separating earned income examples like Minnie as a waitress, which follow a totally different deduction system. All right, but again, all you really need to know for the kiddie tax calculation is these 3 simple layers. All right, so these first amounts of unearned income, right, this first chunk of unearned income is shielded by the dependent standard deduction, right, so it's not taxed. The next amount is taxed at the child's tax rate, so this amount stays in the kid's bracket. Anything above the total amount is taxed at the parent's marginal tax rate. This is the kiddie tax portion. So only the excess above this amount flips to the parent's rate, not the full amount. All right, so that's it. Those 3 steps are literally the whole kiddie tax framework boiled down. All right, so let's wrap this up by going through a quick example of Kiddie Tax. So we're focusing in on Minnie and her unearned income only. All right, so Minnie is 16 years old. She is a dependent of Dave and Margie. She earns $10,000 of interest income this year. Because all of this is unearned investment income, Kiddie Tax rules apply. All right, so the standard deduction for a dependent is this first amount, and the Kiddie Tax threshold is this total amount. So now we run through the 3-layer Kiddie Tax brackets, which is also steps 2, 3, and 4 in our mental map. All right, so the first chunk is sheltered by the dependent standard deduction. All right, so 0 through this first amount is not taxed at all. The next amount is taxed at Minnie's tax rate. All right, so Minnie, the child, pays tax on the next layer in her tax bracket. And we're going to assume that Minnie's tax bracket here is 10%. All right, so for the purpose of this example, we're going to calculate the first amount times 10%, which gives us this first tax portion. So any amount over the total threshold is then taxed at the parent's marginal tax rate. All right, so we see here that Minnie earned a total of $10,000, and we're collectively reducing it by the 2 amounts that have either been entirely sheltered or first taxed at the child's tax bracket. All right, so we have this total amount left over, and this is the portion of the $10,000 that is now taxed at her dad's tax rate. David's tax rate is 24%. All right, so we have this remaining amount times 24%, which gives us the next tax portion. All right, so the final Kiddie Tax total payment, or tax owed, is going to be the first amount from the child's tax bracket plus the portion that is taxed at the parent's tax rate, which gives us this total amount in Kiddie Tax. All right, so they love tricking candidates by making them think the entire amount flips to the parent's tax rate. No, only the excess above this total threshold amount will flip.